So, what should we start with?
So I think a lot happening, Nikunj, in the world. I was listening to some of your conversation prior to this, and I think there is this lot. First and foremost is I think we should be discussing what Fed is going to do, and when is really this halt? When does Fed get this comfort that look inflation is under control, and it's time to wait and watch the impact of the previous rate hikes. I think that's very important. The financial stability is a question which is going to be asked time and again over the next 6 months. So we are in for choppy 6 months here.
Uh, we all know the classic cliche, never fight the Fed. Now, Fed this time is sounding stubborn. Some would say arrogant, but they want to bring inflation down. The cost of that could be short-term pain, medium-term challenges. How much of this entire Fed path of tightening stroke inflation fighting is something what markets are pricing in?
Markets have priced a part of it, not fully. And what I'm saying is, look, part of it is priced in the regional markets like Korea or China, which have corrected massively. I'm not sure it's priced that much in India, more so in rupee. And why I say that is, look, our reserves barely 6 to 8 months back was 640, $650 billion. They've come down to about $535 billion. If we see trend for last 5 6 months, we are losing almost 5 billion a week. I think that is where the pain comes in the India growth story. On ground, the growth story is strong, though it's going to get a bit slower in coming quarters. But I think reserves is something which one need to watch more closely in India.
Rahul, now they always say that you should stay with the strength and sell what is not working. If India as the investment destination is working, yes, it could be expensive. Is it a good idea to start exiting or start selling India positions just because it is working? It is working for a reason, right?
Absolutely. See, I think that's the call we are taking. That look, we are looking at our portfolios and seeing what are the names which offer a favorable risk reward from a medium term perspective, 3 years. And irrespective of the fact that they've outperformed significantly, if one likes those names, one is holding on to names. And there may be a slight profit booking here and there at the margin, but largely we continue to maintain our India overweights. Where one needs this comfort is on the reserves. And I think may not be a bad idea for RBI to do something which was done in 2007, 2008, have a 100 billion line with Fed. That gives comforts to the investors that look 6 months down the lane when reserves are at 475, $500 billion, RBI is not going to slam the brakes hard. So any incremental comfort on reserves means this India story, which is obviously going to slow down, but relatively looks much better to rest of the region, would keep continuing and would not come to a sudden temporary halt.
Rahul, hi there, morning. So, given the fact that the risk reward is looking favorable, you're maintaining that India overweight. Highlight for us what the preference is and where the focus lies in terms of the portfolio strategy.
So clearly, if we look at our regional funds, what we've done kind of a temporarily is gone a bit defensive, added more to the hospital names, added more to the consumer staples, etc. Reduce a bit of our financials. But if you ask us, we out 1 year out, we continue to like the financials, consumer discretionaries. For the India funds, we ran from here a similar thing which we've done. Just made the funds more towards a defensive tilt from next 6 to 9 months perspective, and longer term again it's a strong domestic story. So in tune with that, near term again some of these consumer staples, some of the good IT names which have support or buybacks behind them would be good places to park some money. And as one gets comfort on the stability of the reserves, the stability of the currency, I think that would be the time to get more positive of the domestic cyclicals.
Okay, fair enough, Rahul. Just shifting a focus tad bit, and I'm intrigued to hear your view when it comes to China, because we were speaking with Jim O'Neill yesterday, and he said perhaps it's a little bit early to completely write off China, because when there is a recovery, there is a possibility that it will bounce back faster than the rest. Since you're closer to the ground, what's your assessment of what's happening in China and China versus India trade?
Okay. So what happens is, look, as China opens up, and look, this is a question which has been debated number of times this year, particularly as China relaxes on some of these COVID restrictions. There is a pent-up trade which is there in the market, and look, with the valuations these names are, some of the tech names in China have corrected by close to 60-70% from highs. These names can easily bounce back 30-40%. So near term, as China reopens, obviously China can outperform India and other markets in the region. Longer term, I think some of those structural issues of deleveraging, the structural issues of the excesses in the real estate are going to come through. So longer term, over a 3-5 year perspective, one is very confident that India, in terms of GDP growth rates, markets would outperform. But near term, because China is so cheap and India goes through this kind of a course correction where we are a current account deficit country, that may kind of work to China's advantage, and China may outperform India.
How would you rate Indian IPT companies now that the cat is out of the bag? We know that demand is not a problem and supply side issues, which is attrition and margin, is coming under pressure. Is getting sorted.
So what happens from here is, again, we'll see some bit of a slowdown in demand, but we're still hopeful that, look, demand is going to stabilize somewhere around 7-10%. Previous quarters, we saw margin issues, and the margin issues largely came on back of the fact that subcontracting costs for these companies ballooned, which is going to turn favorable from this quarter onwards. What we're going to see is these companies also get some bit of a tailwinds from rupee depreciation. Look, rupee had depreciated a little against USD, but had appreciated against most other currencies before the beginning of this quarter. I think that changes in coming 6 months. So again, IT would be a good place. And what we've typically seen is somewhere around October, November, these companies resume their buybacks. So that gives a flow to the stock prices.
All right. What about the view on the entire financial space? Given the fact that you think IT is looking favorable at the moment, there have been a number of recent sells within the financial sector. Why is that, given given that they are a key pillar of strength in terms of their weightage on the markets?
So financials, look, the micro is going to be as good as it's been. I mean, this is the best set of numbers you will see in the last 10 years. But I think at inflection points or at certain times, I would say macro kind of dominates strong micro. And that's where the concern is that, look, if rupee continues to show this weakness, if we continue to see the reserve depletion, what we may see is RBI being hawkish than usual over the next 6-9 months, and that impacts the multiples, the valuations for the financial sector. Because let's not forget that it's a levered sector. So basically, with a capital adequacy of 12-13%, you get a 8 times leverage on the economy. So if there is a temporary slowdown in the economy, the sector would, despite strong micro fundamentals, may not outperform.
Rahul, so what should be the return expectations for next 2 to 3 years? Not in dollar terms, but in absolute terms, because dollar, the minute I put that in, gets tricky.
Yeah. So again, Nikunj, I think the expectations have to be in line with earnings growth, and we still believe that over 3-year period, you will have kind of an 12-15% earning growth. What you may see is a little dip as kind of an RBI slows down the economy to manage the trade deficit. But look, our medium-term fundamentals are strong. It's a fresh investment cycle. Whatever the government's doing to attract FDI is going to be a serious tailwind for next couple of years. So the medium-term outlook is the best it's been in last 10-15 years. The challenges are more from a near term, which is where I'm saying that as we get comfort on the reserves, whether it's a line of credit from Fed or anything else, etc., we can continue with this strong medium-term story even in the short term without compromising long-term growth.
Rahul, at the beginning of the year, the positioning was that interest rates will remain low for long, inflation will not come back, and now the positioning is that growth is over, recession is around the corner, and inflation is here to stay. So what changes that in terms of the earnings? How does that change the template of the market? How does that change the medium-term return forecast?
So what's happened is, look, with the conflict in Ukraine, with what has happened between US and China, and some of the support we saw from China for Russia. Nearshoring is going to become all the more pervasive, and look, that is inflationary. And this thing about getting energy security and the risk from climate, and as one builds solutions for that, is inflationary. So what we're going to see is some bit of inflation is good. What we are suffering today is from too much inflation, but with that some of an inflation remaining, that means higher demand for credit for the banks. That means the investment cycle picking up. So that's something one is seeing across countries. That's happening in US, that's happening in India, that you have a strong confidence from medium and small scale enterprises on scaling up. So that's where we get excited from a medium to a longer term perspective. The near term challenges we discussed before.
If you have to buy one trade for next 3 years and you would stick to that trade irrespective of Fed or RBI or rupee or Russia, Ukraine, which will be that trade, and which is one sector or theme you would avoid irrespective of how attractive the valuations are?
Okay, so I would again be still in that inflation camp. Look, near term, as Fed kind of an over tightens, we'll get a deflationary scare. Near term, there is a real risk that over next 2-3 months or over next 6 months, there is a threat to the financial stability of the system globally, and that's where policymakers will come in and they'll capitulate, and you may see some bit of an yield curve control kind of a coming through. So inflation is here too. And that's where one looks at the place on inflation. So you look at good competitive companies in the manufacturing space. Look, what is going to happen is each of the countries are going to focus on the manufacturing competitiveness, building their own strengths. Financials would do well. Some of these consumer discretionary names we like. Again, what we're seeing is a big consumer upgrade. We're seeing is the penetration story kind of coming as a strong tailwind. So there are a lot of good ideas. So if you ask me 3 years, I'm very confident on markets. What one is just seeing is this near-term hiccup which is going to come.
Very confident on the market from a 3-year view. Thank you, Rahul, for joining us today. Really appreciate your time and talking to us about the India story, what's happening across the globe, and what are the things we should watch out for. But since you talked